Hey there, future financial geniuses. Welcome back to the channel. If you're looking to build wealth over time and play the stock market game, you're in the right place. Today, we're diving into two investing strategies that people always debate. Drip investing versus timing the market. It's like the tortoise versus the hare, slow and steady versus trying to hit the jackpot. Alright, let's break it down. First up, we have drip investing. And no, I'm not talking about a leaky faucet here. DRIP stands for Dividend Reinvestment Plan, and it's a strategy that allows investors to automatically reinvest the dividends they earn from stocks back into more shares of that same stock. So instead of collecting your dividends in cash, they just get used to buy more stock, growing your investment without you doing anything. It's like setting up your own little money machine that just keeps churning out more money. It's the ultimate set it and forget it strategy. If you've ever wished you could just click a button and watch your money grow while sipping a margarita, this is probably the way to go. So, here's how it works. You buy shares of a company that pays a dividend, companies like Coca-Cola, Procter & Gamble, or Johnson & Johnson, and every time the company pays a dividend, it automatically buys more shares of the same company for you. Over time, those extra shares generate more dividends, which buy even more shares, and so on. It's like compounding magic happening right before your eyes. One of the biggest advantages of drip investing is that you don't need to worry about constantly managing your portfolio. It's a low-maintenance, long-term strategy that allows you to build wealth over time. Plus, since you're reinvesting your dividends, you can buy more shares even if the stock price is high. This is called dollar-cost averaging. In other words, you're always buying in, no matter what the market is doing. Another cool thing, DRIPs usually don't charge a commission fee, so you can keep building your position with minimal cost, essentially getting paid to do nothing. Now let's talk about timing the market. It's one of those strategies that makes you feel like you're playing the stock market as if it were a video game, trying to buy low and sell high like some Wall Street wizard. Basically, you're trying to predict when stocks are going to go up or down, and you jump in at just the right moment to make a killing. It sounds like a dream, right? But it can also be a bit like trying to guess which way the wind is going to blow tomorrow. Some people get it right, and others end up looking like they just got hit with a hurricane of bad decisions. Here's the concept. You're not just holding onto your stocks for the long haul. Instead, you're actively watching the market, buying when prices are low, and selling when prices are high. Timing the market is about getting in and out at the perfect moments, and it's typically short-term in nature. The big idea here is to profit from market fluctuations. If you're good at reading trends, news, and economic indicators, you might be able to predict when stocks are going to rise or fall. It's fast-paced and can lead to big gains if you have the skills or the luck. But here's the catch. Most people who try to time the market fail. It's incredibly hard to predict market movements accurately and consistently. Even the professionals who do this for a living sometimes miss the mark. So, while timing the market can be tempting, it's also very risky. So, now that we know what drip investing and timing the market are, let's compare them head to head. Here are a few key factors to consider when choosing between these two strategies. First, let's talk about risk. Drip investing is considered low risk because you're not trying to predict market movements. You're just holding on to solid companies, reinvesting your dividends, and letting the power of compounding do the heavy lifting. With timing the market, however, you're taking on more risk. The goal is to profit from short-term market movements, but if you guess wrong, you could lose money. Drip investing is like playing the long game, while timing the market is like trying to ride a roller coaster. You might get a thrill, but it's not always smooth, and you could end up with a stomach full of regret. Second, let's talk about effort. With drip investing, once you set it up, you don't need to do much. You're not actively checking the market every day. On the flip side, timing the market requires constant attention. You've got to stay up to date with the latest news, read charts, and make quick decisions. It's a lot of work, and it can be mentally draining. Drip investing is the chill and let it grow option, while timing the market is for people who like to stay on their toes and constantly watch the stock ticker. Finally, let's talk about returns. Drip investing might not give you instant gains, but over the long run it tends to produce consistent, steady returns through dividends and the power of compounding. With timing the market, you could make big gains quickly, but it's a lot harder to sustain those gains over time, especially when the market is volatile. So, which strategy is right for you? Well, that depends on your personal goals and your investing style. If you're in it for the long haul and don't want to stress out about daily market fluctuations, drip investing might be the way to go. It's a great strategy for those who want to steadily build wealth without constantly checking their portfolios. But if you're someone who enjoys the thrill of the market and you're ready to put in the time to research and predict market movements, then timing the market could give you the rush you're looking for. Just be prepared to ride those highs and lows. So there you have it, folks. Both drip investing and timing the market have their place in the world of investing. Drip is for those who want to sit back, relax, and let time do the work. Timing the market is for the risk takers, the strategists who thrive on making big moves. The question is, which one works for you? If you enjoyed this video, make sure to like, subscribe, and share it with anyone who's wondering how to approach the stock market. Trust me, they'll thank you later. Also, let me know in the comments. Are you more of a drip investor or a market timer? I'd love to hear your thoughts. Thanks for watching, and as always, happy investing.